Hi friends, namaskar and welcome all of you to my channel. Today let's discuss about the trade-off theory of capital structures, under which we need to understand about the what about the bankruptcy cost, non-bankruptcy cost under the financial distress, and what about the agency cost, and at the same time I will be discussing about the present value of debt tax shield friends. Basically when we say that what about the capital structure decisions, and whole capital structure concept you could categorize. One is the relevance of capital structure, that means the way we finance our business will affect the value of the company, that is called relevance of capital structure. But at the same time we say that when the way we finance our business will not affect the value of the company, that is called irrelevance of capital structures. Now what about the friends is the trade-off theory of capital structures. Then this is all about when we use the like your debt above the optimal level, then that causes we say that financial distress situation to the company. And this is all about your, we can say that trade-off theory friends. Now we could explain with this figure friends, that is all about, look at this figure. In we have a, like your x-axis we have a debt level, and in y-axis we have a like your value of the levered form, unlevered form, like that. Okay. Now look at this is like a fixed cost line, which is simply value of the unlevered form. That means when the business firm or any company uses just equity sources, then that is known as the unlevered form friends. And the value of the unlevered form means that is the operating company's operating profit, which is the EBIT, earning before interest and tax. This is simply sales revenue minus cost of goods sold. Then we deduct the operating cost, including non-cash expenses, cash and non-cash expenses. Then we say that that is the EBIT, and EBIT into 1 minus TC, that is the tax rate. When we have a corporate tax rate is there, then we say that is your TC, then whole divided by cost of equity capital. Since the business firm entirely use the equity sources, so we have to use the cost of equity capital. Okay. Now this is our value of the unlevered form. Now what about the present value of debt tax shield friends? Important point that you need to understand, even in Modigliani and the Miller in 1958, that is the, you can say that yeah, authority paper in the area of capital structures. That is when the company uses the debt sources, and company need to pay the interest, and interest is the, we can say that in income statement EBIT minus interest on debt, and that reduces our we can say that earning before tax, and that is why there will be the, we can say that present value of debt tax shield or interest tax shield. We can say that that is simply, equation is that DTC, that is your debt amount into corporate tax rate. Okay. So this is all about your present value of debt tax shield. Now next important point that we need to understand here, the optimal level, that when the company uses the debt beyond the optimal level, then there will be the, this line is the maximum value of the firm. This is the point. But beyond that point, your, there will be the other cost. We can say that that is simply, this is the cost of financial distress, we say that. So this is the present value of the cost of financial distress. So the value of the firm in this case, we say that value of the unlevered firm plus present value of interest tax shield, or you can say that debt tax shield, minus present value of cost of financial distress. So you need to understand here friends, that is the, like your, when the company uses the debt, definitely there will be benefit, no doubt. But what type of cost would be there based on the like your benefit and cost of using debt I'm talking about. Then cost would be like your legal and administrative fee in the bankruptcy case, and indirect cost would be that lost sales, yeah, damaged reputations, yeah, you can say that decrease employee productivity. And important next point is that higher borrowing cost, that's your interest rate will go up, and because of that reason company will unable to meet its financing cost. Okay. So that causes the high financing cost, and even the sometime we see that the bankruptcy cost would be there, and the loss due to sale of assets at the very low price. That means when you are not doing your business is not performing well, so in that case we have to sell our business even at the low value. So you can say that this trade-off theory, friends, we could conclude like this. Yeah, developed by Modigliani and the Miller, discussed the things in 1958, and even the firm balanced the tax advantages of the debt, that is the simply present value debt tax shield, against the cost of financial distress and the bankruptcy, which was again discussed by the Modigliani and the Miller in 1963, friends. So I believe that whatever I discussed today about the concept of trade-off theory of capital structure is very important when you are doing research in this area. So we have to take the reference of this theory, friends. Okay, friends, these are the things that I would like to share today. I hope whatever I discussed today, it will help you to clarify about the trade-off theory. If you really like this content, please like, subscribe, and also share my channel, that is the Finance Guru Pawan Kumar Jha, friends. Thank you all of you for watching this video. Please take care all of you. Thank you.